Hello, good morning, everyone.
Good morning, sir.
Hello, good morning, everyone.
Good morning, sir.
Good morning, sir.
Good morning. Emma, is the screen visible to all of you? Hello.
Yes, sir.
Yes, sir. Visible.
So this is the 14th chapter and the last chapter in the SFM, Strategic Financial Management, last chapter. So probably we'll expect a 4 marks theory question on this chapter. We can expect a 4 marks theory question on this chapter, Start of Finance. So before discussing this theory, first we'll discuss a little bit about why we are separately discussing about the Start of Finance. What is the difference between the traditional finance and the startup finance? Why is the difference between traditional finance and startup finance? Like how a Reliance company borrows, why can't the Byju's borrow in the same way? Byju's a startup, why can't the Byju's borrow money in the same way as the Reliance got the funds? What makes the difference between established funds and the startup companies? Okay, so first you have to understand. Okay, so let us recollect our basic knowledge. What are the traditional sources of funding? Traditional sources of funding. Traditional sources of funding. Traditional sources of funding. So what are the traditional sources of funding we have seen? So first point, public issue of shares. Public issue of shares. So traditional source of funding. So traditional source of funding, first point is public issue of shares. Public issue of shares. Next to bank borrowing, borrowings from banks. Borrowings from banks. Okay, so this is public issue of shares, or you can say securities. It may be shares or debentures. Securities. Okay, maybe shares or debentures. Example, it may be shares or debentures. Shares or debentures or bonds, whatever you call it as. So equity capital and debt capital. Equity capital and debt capital. These are the two fundamental sources of funding. Right? Why can't the startup company, which has recently started, why the startup company cannot make use of this? Why we have to use a separate chapter and dedicated discussion about startup finance? Why they cannot use this? That is the basic question you should ask. So what is wrong with the startup company? Why they are not able to use these funds? Why are they not able to use these funds? First, focus on this point. Very simple. Borrowings from banks, very lowest rate of funding. Bank borrowings is the cheaper source of finance. Traditionally, bank borrowings is the cheaper source of finance. Then why the startup company cannot go for the bank finance? Okay, right. So first, our question number one. Okay. So question number one: what is the cheaper source of finance? Okay, what is the cheaper source of finance? What is the cheaper source of finance? What is the cheaper source of finance? The answer lies in bank borrowing. Borrowings from banks. Borrowings from banks. So, question number two. Why can't the startup company use the bank borrowings? Why can't the startup company use the bank borrowings? Why can't the startup company use the bank borrowings? Makes use of bank borrowing. Why can't the startup company avail bank borrowing? This is the question. Why can't the startup company can avail bank borrowings? The reason is first point, because of lack of security. First point, startup company lack of security. So startup company cannot offer to give security. Usually banker will not give unsecured loans. Banker will insist on certain amount of security or collateral for a loan. Startup company may not be able to offer them. A company like Reliance may have well-established fixed assets, which they can offer as a security to the banker for availing a loan. But a startup company cannot avail that loan. Because they can't offer to give security to the banker. That is what the point. Next, that is the first point, lack of security. And next, lack of certainty in their business model. Lack of certainty in their business model. Okay, lack of certainty in business. Lack of certainty in business. So lack of certainty in business. Okay, if the business is uncertain, banker will not lend the money. Banker is not willing to take the risk. Banker is not willing to take the risk. Okay, lack of certainty in business. So banker will not lend money to the risky ventures. Banker will not lend money to the risky ventures. That is the question mark. In other words, banker will not lend money. Banker will not lend money to risky ventures. Banker will not lend money to risky ventures. That is the question mark. Why, sir? Why the banker will not lend money to risky ventures? Because whomsoever has deposited money in the bank, they have deposited for the sake of safety, not for the sake of income. If I go and invest money in the bank fixed deposit or bank the savings account, my goal is safety of money, not the income growth. So therefore, banker cannot take too much risk because public deposit is involved. In fact, even mutual funds, venture capital funds, private equity, wherever you go, end of the day, public money is only involved. No doubt about that. But within the public only, those who invested in the bank, their primary motive is safety of principal, safety of capital protection. Their primary goal is not income earning. Those whomsoever has deposited in the bank, their primary motive is safety of capital or capital protection. Those very public, whoever has invested in mutual funds or venture capitalists or angel funds, their goal is to earn the income. That is the reason. You got the point? The public who deposited money in the bank, their primary motive is safety. Therefore, banker cannot take too much risk with their money. If the banker loses the money, public will lose faith on the banking system. That is the reason banker cannot take too much risk. Unless until the business is very certain, banker will not lend the fund. Banker will not lend the fund. That is the point. So therefore, in case of startups, what happening is, one important point we have to understand. Where every new company is not a startup company. That is the golden point you have to remember. Whenever I say startup, don't think that a new company. Startup is not simply a new company. It's also a new business model, new way of delivering the old product, or delivering a new product, or delivering to new customer. Okay, you got the point. Startup company. Startup involves some innovation. Okay, something they are trying for the first time. Startup company, something they are trying for the first time. Okay, that is the reason risk is involved. If you do the same kirana shop business, banker will not find any risk in the kirana business. Banker very well knows how the kirana business will run. Yes or no? So how a hotel runs, how a restaurant runs. Banker very well knows all these things. There is little uncertainty involved in the kirana shop business or running a hotels or restaurants or public amusements, etc. Okay, so here startup companies are doing something new which has not proven. That's where the source of risk arises. Am I got the point? Not every new company is a startup company. You should not call every new company as a startup company. If I start a new college, no, it cannot be a startup company. I have to deliver the same education through an innovative way. Like how the Byju's is delivering through apps, online, etc. Same content they have to deliver in an innovative way. That is a startup. If I take one building on rent and I started giving coaching, it cannot be called as a startup. I have started now, but I am not a startup company. You got the point? If I take a building now and started taking classes, face-to-face classes, then it cannot be called out as a startup because there is no innovation in my business. I am doing the same business in the same way. I am doing the same educational business in the same way. There is no innovation involved. Okay, so therefore, startup definitely involves some sort of innovation. Okay, that is the point. So this innovation is the very source of risk. Innovation, first time you are coming out with something new. So therefore, nobody knows whether it will be successful or not. This is the core point. The root cause of startup companies is the risk. The root cause for startup companies risk is this innovation. Definitely they are trying something new. Okay, it is not for the first time you are doing. Okay, right. That is the point. Because of this innovation, first time we are doing. Innovation means first time we are doing something. First time something new is done. Something new is done. So it has not proven. It has not proven earlier. It has not proven earlier. So uncertainty. So uncertainty. This is where the uncertainty. So therefore, banker is not sure about how this business model works out. Banker is not sure about how the Paytm works, because Paytm first time they have gone all this mobile payment apps, etc., and all those things. So therefore, there is lot of uncertainty involved. Banker is not sure how the Zomato works, how the Swiggy works. It is for the first time they bought. Yes, till now people used to go to the restaurant and either they will take the dinner there or they want to take the parcel there. But it is the first time banker is seeing that some mediator is taking the order from the people and going to the restaurant and bringing the food whatever they want. Something they have done the first time. Same product, same dinner, same product, same seller, same buyer, but new way of delivering the product. You got the innovation. Same product, same seller, same customer, but new way of delivering the product. Same student, same faculty, but new way of delivering the subject by this. So some sort of innovation should be there. Some sort of innovation should be there. That innovation is the very source of risk for the startup entity. Okay, because of this risk, and because of lack of collateral, bankers are not willing to lend money to the startups. That is where the problem comes. Otherwise, all this nonsense, all this stuff is not necessary. Safely and securely, traditionally and comfortably, you can go and borrow money from the bank. Okay, it's the safest source of funding. Bank borrowing is the safest source of funding at cheaper cost. But we are ignoring that. And whatever the startup finance we are discussing in this chapter, predominantly we'll discuss angel investing and venture capital. There are three categories of startup finance: angel investing, venture capital, and private equity. But private equity is not covered in our syllabus. We are covering only angel investing and venture capital. Okay, right. So why all this is very, very risky? It will give you a lot of pressure for your business, less freedom, less returns, very risky. All these fundings are very risky, but inevitably, by compulsion, we are going to them. By compulsion, we are going to the startup finance. Otherwise, bank borrowing is the safest method. Otherwise, bank borrowing is the safest method. Otherwise, bank borrowing is the safest method. Who is this Redmi ID? Who is this Redmi ID? Can you spell out your name? Hello. Who is this Redmi? Hello. Who is using this ID called as Redmi? Can you rename? Hello. Next. That is the point. Okay. So the very source of bank finance is very safest source of funding at a cheaper cost. But the reason, these are the two reasons why the banker is not lending money. One, startup is not in a position to offer security required by the banker, and the startup business is a new business. It is not proven, therefore banker cannot take the risk. Why the banker cannot take the risk? It is not that the banker does not want to take the risk. It is the people who funded money who has deposited money with the banker does not want to take the risk. Am I got the point? It is not that banker is risk averse. It is not that banker is risk averse. It is not that banker is not willing to take the risk. It is the people who deposited money in the banker does not want to take the risk. Okay, that is the reason. So because of these two reasons, they cannot go for the bank funding. Okay, fine. Sir, then why can't they go for public issue of securities? Why can't they go for public issue of securities? This is the question. Okay, so there are many reasons why they can't go for the public issue of securities. Okay, right. Next, question number 3. Sir, why the startup company cannot approach the public? Why the startup company cannot approach the public issue? Cannot make use of why the startup company cannot make use of public issue of securities? Okay, public issue of securities. This is the question mark. Okay, sir, we understood bank finance is not possible for a startup company. And a startup company can very well go for a public issue of shares because issue of those whomsoever is investing in shares, obviously they may be willing to take the risk. Why can't they go for that, right? There are many reasons. There are many reasons. First reason is regulatory hurdles. First reason is regulatory hurdles. First reason is regulatory hurdles.
Hello, sir.
Hello.
Hello,
Sir,
sir.
screen conversion చేస్తుంది.
Ima.
Computer
Screen
screen is
share
not
అయిపోయింది.
visible.
Pardon?
స్క్రీన్ షేర్
Screen
అయిపోయింది.
కనిపించట్లేదు.
Screen share is stopped. Okay.
Yes, sir.
Sorry, sir. Now is it okay? Hello.
Yes, sir.
Okay, sir.
Yes, sir.
So this is the point. Okay. So why the startup company cannot make use of public issue of securities? Regulatory hurdles. Regulatory hurdles. Example, if you use, as per SEBI ICDR regulations, issue of capital and disclosure requirement regulations. As per SEBI ICDR regulations, only a profit-making company can make a public issue. Only a profit-making company can make public issue. Okay? Only a profit-making company can make public issue. I think I have to mute. Okay? So only a profit-making company can go for public issue. Can use public issue. Can approach the public. That is the point. Okay? At least 3 years they should have consistent profits. At least 3 years a company should have consistent profits in order to approach the public. That is the very reason why the Flipkart is planning to list its shares in NYSE, New York Stock Exchange, rather than in BSE or NSE. Because of this hurdle, you cannot approach it. Another reason is that since the company is not yet making profits. In fact, the company is not even generating revenue. The company is not even generating revenue. So the investors may not fail. The investors may not show interest in investing in such company. May not show interest in investing in such companies. You got the point? So bank borrowings were clear. Why the startup company cannot go for the bank borrowing? Because of 2 reasons. Since they have started now, they don't have any assets to give collateral security to the banker. And since they are starting some new business, the business is very risky and the banker does not want to take the risk. And next, why can't they go for public issue of shares or debentures? Because of regulatory hurdles. Because they have not even started generating revenue. So they don't have any profits at all. They can't go for the public issue. SEBI hurdles. As per the regulatory hurdles. And moreover, the people are not interested to purchase. The people are not interested to invest in these companies because they don't even have a revenues on that. Investing in startup companies is always risky. So who knows that the Facebook is successful so much today? Today you are seeing that Facebook is successful, but the very day when it has been launched, nobody knows. It is a new model. It's a new way of interaction among the people. Social media. So therefore, it is very risky to invest in such companies. More than conservatively, I am saying, optimistically, I am saying, more than 90% of the startups are failures. 90%. That is sure. That is for sure. 90% of the startups are failures. That is the very reason why the bankers and these normal retail investors are not willing to take this. I got the point. Retail investors and small investors, they don't have risk-taking ability, or they don't have skills to manage the risk, or they don't have willingness to take the risk. 3 reasons. They don't have ability to take the risk. They can't afford that much of money, and they don't have that much of skill to evaluate the risk. And psychologically also, they are not willing to take the risk. I'm talking about the retail investors. If you go for the public issue, at least minimum 50% you have to offer to the retail investors. Okay, right. Those retail investors, 3 problems. First, they don't have enough money to lose. Okay, if I'm having 100 crores, I can lose 1 crore. 1 crore is not a matter for me. I can lose 1 crore. If I invest 1 crore in a particular company and that entire 1 crore gets lost, I'm not affected because for me it's a small amount. Okay, that is the thing. So big investors, we are calling them as HNIs, high net worth individuals. Okay, they have crores of money. Even if they lost 1 or 2 crores in one venture, they have invested 1 crore in one venture, and that entire 1 crore has been lost. Still, they have not affected because of compared to their wealth, it's a meager portion. It's a meager portion. But it is not the case with a retail investor. I am hardly saving 50,000 or 80,000. If I invest entire 1 lakh in one company, my hard-earned savings, and that entire 1 lakh is lost, and that entire 1 lakh is lost, what is my fate? You got the point? That is the reason. First point. So retail investors are not having enough wealth to lose. Okay, that is first point. And second point is that they don't have skills to evaluate the risk. What is the probability of success of this new venture? They don't have skills to evaluate the risk. They can't take the calculated risk. And third point, psychologically also, they are not habituated to take the risk. They are not habituated to take the risk. So those who have already taken an entrepreneurial activity, they have traveled through the risky path. If I am an employee, I am going to the office from 9 to 5 or 9 to 9. I am not taking any mental risk. I am only giving the physical strain. No mental risk is involved. So therefore, psychologically, I am not habituated to take the risk. I'm not habituated to take the risk. That is the reason, being a retail investor, I cannot invest in a startup company. On the other hand, if I'm a veteran, if I worked in industry for 30 years, I worked as an entrepreneur like Ratan Tata or all these people, who is that person? Who is that person? Nandan Nilekani, all these persons. So they can invest in startup company because they have walked through the path of risky ventures. They have seen the risk. They have seen the risk path. They are comfortable with the risk. They are comfortable with the risk, but not like retail investors. That is the reason retail investors are not willing to invest in the startup company. Am I got the point? Right. So that is the point. But the same three problems will be overcome by the angel investors who has already worked in industry in the top management and who has a lot of wealth. They can offer that. They can offer that one. If Nandan Nilekani is having approximately 7,000 crores of net worth, he can offer 5 crores or 10 crores. Nothing for him. Out of 7,000 crores, 5 crores or 10 crores is nothing for him. He can offer that one. First point. And second point is that he has the skill. Since he has worked in the industry for more than 3 decades, he has the skill to evaluate the risk. And the third point is that since he has already taken an entrepreneurial risk, he is comfortable with the risk. All the three problems which the retail investors are facing are avoided by this angel investors or veteran bankers. Okay, you got the point, right? That is the reason. So these are the peculiar features of the startup. Why they cannot go for the traditional bank borrowings and traditional source of funding. Am I right? So why we have to separately discuss about the startup finance? Why we have to separately discuss about the startup finance? Okay, this is the reason. Am I right? Next. Next, we'll see one by one. Okay, these are the ground realities. These are the ground realities. But whatever we are discussing in this chapter, there is no standard definition or there is no fixed way that this has to be happened only in this way. No, purely customized. All startup finance is customized. All startup finance is customized. If I say that angel investors will invest in early stages and venture capitals will come only in the later stages, it may not be the case. If you are able to convince even the venture capital can invest in the startup company, there is no legal hurdle. There is no legal hurdle in that. All are customized. It's on one-to-one contract basis. It's on one-to-one agreement. Okay. Whatever we are discussing, it is not a standard. Most of the cases it is happening like that. Most of the cases it is happening like that. It is not that this is the only method we have to raise the finance. Okay, right. So now we'll discuss my first point: ways to finance a startup. Personal finance. First point. Look at this point: personal finance. It is important for the new entrepreneurs to put their own money. Into their venture, as the outside investors will not put their money unless the promoters also contributed money from their personal sources. That means even if you are raising money from outside sources, at least you should invest 10 to 20% of capital required by your own. You should have some skin in the game. You should have your skin in the game. Then only other people will oppose it. Because if you are not investing even a single rupee, the outsider will not rely on you. You don't have fear over the business because you have not invested any rupee in the business. So that is the reason. Okay. Unless until we put our own money, whether it is 10% or 20%, we don't have commitment over that business. We don't take that business very seriously because we have not invested in money. Even if the business is vanished, the investor will vanish. We are safe. With that perception, we may not be showing commitment. That is the very reason. Unless until you put some money, whether it is 10% or 20%, unless until the promoter or entrepreneur invests some money, put own money, they have to invest at least some portion. The outsider will not invest. That is the first point. You have to use your finance. That means unless until you have some financial backup, reasonably, if not high net worth, at least you have reasonable finance of say 10 lakhs or worst case 10 lakhs. At least in the worst case 10 lakhs or 50 lakhs. If you have own money, if you have your own money, you cannot invest in it, you cannot start a venture. Okay, right? That is the point. So own money, entrepreneurs own money. Whoever got the idea, they should invest own money. Entrepreneurs own money is the first point. It may be very less percentage, but at least they should invest some. And next, so see this specular future. This may not be possible for the youngsters. This may be possible only for the proven people. Okay, personal credit lines. These are based on one's personal credit history. These can be availed only when the business has enough cash to repay the credit availed. See, this is the very peculiar thing. Business has cash to repay the loan and the person has credit history. That means the entrepreneur has shown his integrity and honesty and commitment in repaying the loan. I have already taken n number of loans. I am an entrepreneur. I have taken multiple loans from various banks. All the loans I have repaid. My credit history is very clear. That means I have shown my integrity, honesty, and commitment to repay the loan. That is my personal credit history. But my business has not even taken a loan single time. It is the very first time my business has approached the banker or a private equity venture. You got the point? I personally have borrowed money from the banker a couple of times or multiple times, and I have repaid promptly, and I have a clean credit track record. Okay, right. But my business is the first time my business is borrowing money. By seeing my personal credit history, banker is giving a loan to the business. You got the point? By seeing personal credit history, banker is giving a loan. If Ratan Tata starts any new business, the business may be new, but Ratan Tata is old. Ratan Tata is familiar to the banker. Business may be new to the banker, but Ratan Tata is familiar to the banker. Okay, that is what the point. Okay, business is new, but Ratan Tata is old. So the based on his personal commitment or integrity, banker will lend. Okay, that is first point. The personal credit history. Personal credit history. This is the first point. Okay, personal credit history. And second point is that personal credit history is not sufficient. Just because I have proven track record. Okay, boss, till now I am working in a company, I am getting monthly salary. Maybe that is the reason I am promptly repaying the loan. Now I have resigned from the job. Now I have started a new company. I don't know whether the new business will generate the cash. Then the banker will not lend. That means my personal credit history is the essential point, but not a sufficient point. You got the point? Personal credit history is the essential aspect, but not the sufficient aspect. Okay. Till now I am working in a software company. I am getting 5-digit salary or 6-digit salary. Okay, I used to repay the loan promptly. That's fine, boss. But now I have resigned from the job. Now I am starting my own business. Okay, but how the business will generate the cash? Therefore, business has enough cash to repay. Business has enough cash flow to repay. This is the very point. Those two has to be satisfied. Even if the business is having enough cash, but the promoter has not any proven credit history, banker may not be able to give it. That is the 2 points. So both has to be satisfied. Personal credit history and the business cash flow. Both should be satisfied. That means character and competence. Business should have competence to repay the loan, and person running the business should have character or willingness to repay the loan. This talks about ability. This talks about ability. So this is ability to repay the loan. Okay. This talks about ability to repay the loan. This talks about ability to repay the loan. Ability to repay. Okay. Whereas this talks about willingness to repay. Because in the past I have proven. Okay. Willingness to repay. Willingness to repay. This is what the point. Okay. So ability to repay and willingness to repay. Both should be there. Then only the banker will be willing to lend the money. Okay. Right. That is the point. Next, family and friends. In addition to the personal finance and personal credit lines, we can obtain funds from the family and friends. This is what popularly called as angel investing. So in our CFA, we used to say F cube, family, founders, and friends. Founders, family, and friends in the sequence. F cube, founders, family, and friends. Founders first, whoever is started. That is personal finance. Next, family and friends. Okay. Founders, family, and friends. These are the first source of funding, first stage investing. Okay, right? These are the people who will rely, who can trust you immediately. If I go and ask to the bank or HDFC Bank or ICICI Bank, they don't know what is Aditya. But my students may be knowing that. Students are my friends, they may be knowing that. And my family members may be knowing my abilities and my character. Am I correct or not? My family members knows me very well, my character and my ability. And my students knows my character and ability. They may be able to trust me, but not a new bank or HDFC Bank or ICICI Bank. They don't know about me. They may not be able to trust me. Okay, that is the very reason. Okay, family and friends. Next, peer-to-peer lending. This is rarely happens. Small business groups having similar interest support each other in startup venture. If I have surplus cash, I am lending you, and if you have surplus cash and you are lending you, it won't work out. The scale will not feasible here. If myself is facing with lot of problems, financial problems, how can I lend to you? Both are small business. Both are small business. Even it happens, it has least impact. It has least impact on the business survival or growth. Least impact on business survival and growth. Least impact. Okay, maybe emergency situations they can prevent from falling the business, or they can what all they can do is that they can delay the winding up of a company. That's what they can do. Rather than immediately wind up, they can make the company will survive for a while and wait for the right time to wind up. Or they may prevent the company for winding up. That's the most they can do. That's it. They can't enhance the growth of the company because their magnitude is very less. If I am taking money from the small business, the very word small business says they themselves need funds. How much they can give? How they can give 5 lakhs? That is not sufficient for me. They may give 10 lakhs. That is not sufficient for me. Okay, right. So therefore, it won't have a lasting impact. This source of finance may not have a lasting impact. Okay, right. That is the reason. These are the points. Next, crowdfunding. Now you can use this point. It refers to the use of small amounts of capital from a large number of investors. That means, just now I have said, within the retail investors also, there are some category of, there may be some people who are ready to take the risk, like youngsters. Within the retail investors, there may be some people who are ready to take the risk, most especially youngsters. Why the youngsters are willing to take the risk? Because they have working life. Even if they have lost their wealth, they have the time to build. An age-old person at the age of 60 or 70, they can't take the risk because once wealth is lost, they don't have time to restart their career. An youngster at the age of 21 or 25, they can take the risk. Even if he loses 10 lakhs money also, he has enough career. He can rebuild that 10 lakhs. You got the point? So therefore, most youngsters can prefer this point because they have the time to rebuild their wealth even if it is lost. Okay, right. So therefore, within the retail investors, within the small investors also, there are some category of people who are willing to take the risk. So you can procure money from them. Crowdfunding, large amount of investors, large number of investors. Crowd means large number of investors. Small amounts from large number of investors. We can start one website and we can take money, small amounts of money from many investors, and we can invest in some other companies. Okay, Okay, right. That is the point. Okay, so the number of investors to finance a new business initiative. It makes use of social media and dedicated crowdfunding websites to bring investors and entrepreneurs together. I'll start a website and I'll ask the people, whoever is willing to lend money, and they will come to the website, and whoever the entrepreneurs is there, they will come to the website. I am the mediator. I will screen the entrepreneurs. I'll evaluate the entrepreneur's financial feasibility. Based on that, I will lend money. Okay, right. This is the crowdfunding. Small amount of investors, they are putting money in the website, and the website will give money to the entrepreneurs. Okay, right. This is called as an investment vehicle. This website is an investment vehicle. Okay, this is the point. So crowdfunding. Okay, right. Next, vendor financing. It is a credit purchase of goods, as simple as that. Vendor financing means it's a credit purchase of goods or taking the fixed assets on lease. In case of inventory, it is a credit purchase. In case of fixed assets, it's a lease, as simple as that. Okay, I want money to purchase the assets, as simple as that. If in the liability side I am taking money, the question comes is why? What is the purpose of taking money from the liability side? Okay, Mark. So if I put our accounting balance sheet, If I put our accounting balance sheet, liabilities, assets. So I'm getting funds, sources of funds, sources of funds. I'm getting funds for why? What I'll do with the funds? I have to invest the funds, application of funds, application of funds. So where I'm applying the funds, basically, if you do fixed assets and current assets inventory, fixed assets and current assets inventory, fixed assets or current assets inventory. So it may be based on basically leases. I can go for leases rather than I can avoid this borrowing. If I go to lease, I did not have any bank loan, equity shares, etc. Whatever the machinery I want, rather than issuing shares, getting money and purchasing the fixed asset, I can take the fixed asset machinery on lease. Emma, do you agree or not? Hello, I want fixed assets. That's it. I want a machinery. Rather than purchasing the machinery, I can very well take the machinery on lease basis. Am I correct or not? Hello. Yes or no? Right. That is the point. Fixed asset I can take on lease. What is done by airlines. So if you want to learn good about if you want to learn a good amount of knowledge about the leases, whether it is AS19 or India AS, etc. So learn airlines. Airlines are known for leases. Airlines. They will make use of lot of leases. Okay, right. All the aircraft, they cannot purchase aircrafts. Aircraft is not a small amount. Okay, so to purchase an aeroplane or aircraft is not a small issue. They can't do that part. Definitely, they are forced to take the leases. That is their fixed asset, but they are using the leases. Okay, that is what the point. In case of inventory, I can go for credit purchases. As simple as that. Credit purchases. Credit purchase. Okay, that is called as vendor financing. Vendor financing. Okay, right. This is called as vendor financing. Okay, deferred payment terms. Deferred payment terms. Am I correct or not? In case of leases, I am not paying the entire cost of the asset at a stretch. I am paying in installments. Even in credit purchase, also I am not paying upfront cash. I am paying delayed. Deferred payment is delayed. Deferred payment means payment is delayed. Okay, that is called as vendor financing. Okay, great. Next, purchase order financing. Purchase order financing. Okay. Right. Purchase order financing. In this mode of financing, a startup business having obtained a large purchase order approaches the lender, who in turn transfer funds directly to the supplier. As simple as that. Purchase order financing. Obtaining finance after having an order in our purchase means for whom it is purchased. For our customer, it is purchased. For us, it is a sales. For the borrower, it is a sales. For the borrower is a seller. Borrower is a seller. Buyer, for buyer it is a purchase order. For buyer it is a purchase order. After the borrower has received the purchase order from the buyer, and by producing this purchase order to the banker or some other lender, they will get the funds. You got the point? Okay, after who is giving a purchase order? Buyer is giving a purchase order. For him it is a purchase. For me it is a sale. Borrower is the seller. For the borrower it is a sales order. For the borrower, it is a sales order. For the buyer, it is a purchase order. So, buyer has given a purchase order to the borrower or seller. By showing the purchase order or a purchase order to the banker, borrower can obtain funds from the banker. Because now the banker is certain. Now the banker is sure, yes, this borrower has some order in his hand. But now the borrower is confident. Now the borrower is confident. Sorry. Now the banker is confident. Yes, this borrower has some business. They have some certainty in generating the cash flows. Based on that, he will lend the money. Based on that, he will lend the money. That is what the point. Based on that, he will lend the money. Okay. Great. Next, that is called as purchase order financing. A startup business having obtained a large purchase order approaches the lender, who in turn transfer funds directly to the supplier. Okay, that is what the point. So once I got a purchase order in my hand, I can definitely approach the banker. Okay, right. So if I started on online classes and I got a good enrollment, by showing the enrollment list, I can go to the banker and I can obtain a loan for equipment and all those things. So I want to build a software. Or technology to telecast my video classes, etc. All those things. App to build the app, etc. So they will make use of this purchase order financing. They will make use of this purchase order financing. Okay, right. Next, factoring. Okay, in this mode of financing, a startup entity having sold the goods on credit trenches. So factoring, Emma, I hope you are familiar with this concept in CA Inter. Factoring, after selling the goods. After selling the goods, we'll approach one person called as factoring agent. We will sell our receivables to the factoring agent and we'll collect the money. Emma, do you got the point? Yes or no? Few voice replies. Did you recollect the factoring concept from CA Inter? Hello.
Yes, sir.
So this is not
Yes,
peculiar to the startup. This is not peculiar to the startup. This is all these are unique to the. I don't know why they are given in the startup finance software, but these are more apt for the established business entities, not for the startups. This vendor financing, purchase order financing, factoring, all those things are meant for the established business. They can say for small business, small established business, but not a startup. But not a startup. That may not be appropriate. I don't know why the institute has included this. This may not be appropriate. This may not be appropriate for this chapter. Okay, correct. But this is what the point: ways to startup funding. Okay. Next, look at this point. Look at this point. Be careful here. Whoever is willing to work in private equity or venture capitals, okay, or you can go and work in a private equity or venture capital firm. If you get a good firm of private equity or venture capital, the advantage for you when compared to others, when compared to MBA people or engineering people, the advantage to CA people is that we can manage two aspects. What are the two aspects we can manage? Finance and legal. We are familiar with the financial management and we are familiar with the laws, corporate laws or taxation laws. We are familiar with it. Even if some new act comes also, we are habituated to read the legal terminology. We are well versed with the legal terminology. Am I correct or not? Yes or no? We are well versed with the legal terminology. By reading income tax law and by reading the Companies Act, we are familiar with the legal terminology. So therefore, if you go and work in a venture capital firm or a private equity firm, you will have more importance. Maybe your entry may be difficult. Even if you get an entry, your salary may be very less, but you will have a good future if you go for a private equity or a venture capital. Because on one hand, you can make use of legal knowledge. I'm telling you, it is the only in private equity and venture capital you can make use of all knowledge of all your subjects. Otherwise, if you go to any industry, even if you are in a big four also, you may not be able to utilize all your subject knowledge. Am I correct or not? You may be working only in taxation, or you may be working only in Ind AS or financial reporting, or you may be working only in the pure stat audit department. Am I correct or not, ma? Hello? Yes or no?
Yes,
Yes,
sir.
sir.
So that is the
Sir.
reason. But on the other hand, if you go and work in a venture capital or private equity firm, you have to make use of your accounting knowledge. You can guide the accounting team because the engineering people and the MBA people, they are not good at accounting. They are not familiar with accounting. So we want the accounting. And most especially during these times. And not only during these times, down the line, the importance of accounting, not accounting, preparation of financial statements, presentation of financial statements. For preparation of financial statements, no doubt softwares are there. Presentation of financial statements. Because the more the risk involved in the business, the more the transparency expected by the investor. Are getting common logic? You got the pure common sense point. The more the uncertainty in the business, the more the transparency expected by the investor. So the transparency is given in the accounting statements only. So for the CFO, transparency is a must. For the CFO, transparency is a must. So being a chartered accountant, being a chief financial officer, you can bring transparency in your reporting. That is one area. That means you can make use of accounting knowledge. And next, you can make use of legal knowledge. So what are the complaints under Companies Act? What are the complaints under the SEBI guidelines? So I have explained, right? Why can't I go for public issue of shares? And MBA people may not be aware of these provisions. And MBA people may not be aware of these provisions. A technical guy, an engineering guy may not be aware of these provisions. But being a CA, you are aware of these provisions. Yes, if they come out with one proposal, you can say that, boss, this proposal is good financially, but legally it is not perfect. This proposal is good financially, but legally it is not perfect. They are not aware of the hurdles. They are not aware of the hurdles. They are only seeing the greener side. They are only seeing the greenery side of the project. But you have to see the gray side of the project also. The other side you can see, boss, these are the legal hurdles. You can't do that one. You can't acquire this because some other, watchdog will come. Competition Commission of India will come. Okay, they will vet your proposal. So these are the legal hurdles to implement the proposal. Being a CA, we have that knowledge to add. Okay, we can add our accounting knowledge and we can add our legal knowledge, and no doubt our taxation laws in India, taxation being a 30%, of your profits is a major amount. It's a major amount. So you can say that. So if you go this approach, this much is the taxation. If you go this approach, this much is the taxation. So you can save taxation. Therefore, you can give a taxation advice for any project, and moreover, financial advice. You know, the discounting technique is called as a net present value or scenario analysis or sensitivity analysis. We know all these steps. We have done the valuation in security valuation software, all these things. Now in corporate restructuring also, we are using the free cash flow method. That means we know the free cash flow method as done by the MBA people also. MBA people are also good at valuation. We are also good at valuation, but they don't know about the accounting, legal, and taxation. But we are aware of that. That is the very reason many entrepreneurs are saying, okay, there are two extremes. Either you can go in this pendulum or this pendulum. If you stick on only to your accounting knowledge, you will be in this side of pendulum. You'll be working at a lower level of your career. On the other hand, if you add the business knowledge to your subject knowledge, then you can flourish. That is the key point here. Okay. So we have the potential. CA has the potential to go for the higher stages because he has a multi-dimensional knowledge. He has a multi-dimensional knowledge. In private equity or venture capital, you can make use of multiple subjects knowledge: taxation knowledge, accounting knowledge, legal knowledge, financial knowledge. Basically 4 pillars: accounting knowledge, legal knowledge, financial knowledge, and taxation. First financial knowledge, because you have to evaluate the project, whether the project is feasible or not. Then you have to use the legal knowledge, what are the legal hurdles involved, and the taxation aspect, how much taxation is involved, and what is the net profit that can accrue to us, and accounting. How we have to present that, how we have to present the past financial statements to bring transparency to the investor. Okay, MIS is very important. MIS is very important. If we add little bit communication skills and technical or computer oriented skills to our subject knowledge, we can go anywhere. Neither the engineering people nor the MBA people will be competition to us. Okay, the only thing is that we are missing adding something. We have that stuff, but we are missing on something. That something is nothing but our communication skills and our technical skills, system skills, and soft skills. How we have to present, how to deal with the people, MBA people are very good at it. Dealing with the people. I'm sorry to say, I have to quote something you have done. You people have done mistake yesterday. Why? Because when I asked you to send the email IDs to add in the Zoom, most of the people have sent the group ID. I think almost all people. Yes or no? It's a small issue for you. Maybe you are sending only through friends. But are you not losing your privacy if you send the mail ID in the group? Am I correct or not? Emma, I think you are not sensible in that area. Are you getting my point? I'm not criticizing you. I'm just quoting an example of being sensible. Emma, do you understand? Hello? Emma,
yes, sir.
Yes, sir.
right. So you should have sent the email ID to my personal mobile, not to the group. That is the sense. But the reason is that you might not have interacted with a lot of people like MBA people, because we don't have sufficient knowledge. Hardly we are interacting with our colleagues, articleship colleagues, or the boss, or the client people also. How many clients you can do in your articleship? Maximum 5 to 10 clients you may interact with your articleship, or your 5 to 10 colleagues. You may not be interacting with lot of people like MBA. So when they go to the MBA college or engineering colleges, they may be interacting with lot of people, and they have that sensitivity. Okay, how to interact, what to reveal and what not to reveal. That may be slightly missing to us. You have to add that pinch. Communication skills. Okay, communication skills in the sense not only English. So when I say communication skills, most of the CA students are confusing with the English knowledge only. It is not only the English knowledge. You may be very good at English, but the presentation is very important. How good you are at presentation, how you are presenting. Okay, that is what the point. Okay, presentation skills is also important. Okay, right. Next. So if you add those points, private equity and venture capital is a good prospect for you. You can make use of all subjects knowledge. Okay. That's what the point. So why I have told is that this is where communication skills, speech, presentation. We have done all the background work fine. But presentation. So as simple as for you in a layman language, I'll give an example. I have constructed a good building. Okay, with solid foundation, I have constructed a good building which can withstand any floods. Okay, etc. Etc. All those things. But if I don't have sufficient painting outside the building, not even people will come and enter the building to watch. Am I correct or not? Foundation may be very strong. I have built the strong pillars. I have used a good amount of cement, steel, etc., sand, etc. The building is very strong. It can withstand any amount of floods. That means my knowledge and my evaluation of the project is very strong. I can withstand anything. But if I don't do colorful painting outside the building, people will not even walk into my building to see. People will not even walk into my apartments to watch and to take a decision whether to buy it or not. Am I correct or not? If the outside appearance is not good, they will not
Yes,
even
sir.
take. Many people may not be willing to enter the building also. That is what is the problem. So therefore, here presentation matters. So therefore, pitch presentation. Here is where the MBA people are good at. But they have one more point. They have one more drawback. They are making excessive use of their presentation skills. So their presentation skills, rather than making, so here the presentation skills means they are trying to attract the investor, but they are not. But our goal is not to attract the investors. Our goal is to keep the investor in a comfortable position. As simple as that. You have to ensure that investor understands the point. That's it. Okay, with our simple presentation, with our simple and lucid presentation, our goal is to ensure that investor understands the core point. That's it. We don't need to try to impress the investor. We don't need to try to impress the investor. That is what the point. Okay, right. So that is where the MBA people are missing here. They are making excessive use of their presentation skills. But these are practically I have seen. Practically I have seen many people, they are using excessive use of their presentation skills and they are losing on the core aspects. Because on the other hand, CA people are very good at core aspects and they are very weak at presentation aspects. When I say presentation skills are important, some of my friends are simply copying the PowerPoints made by other MBA. Whoever is from the IIMs or from the big schools, whatever the PowerPoints they have made, these people also they are copying the same things. No, you can't do that point because they are extremes. The MBA people presentation is extreme. They are making excessive use of their presentation skills in an effort to attract the investor. No. Take something from them, not everything. Be very clear. Take some presentation skills from the MBA people, not everything. If you take every presentation skills from the MBA people, you are front. Okay, they are not good at. It is not good. You can't invest. You can't bring a good investor who has the patience to wait for the returns. Okay, so this is very important. Moderate amount of presentation skills. Am I got the point? Moderate amount of presentation skills, not excessive presentation, excessive attractive. Okay. Right, that is what the point. Okay, so pitch presentation is very important. Okay, right. I got the point. So it's our goal of presentation is focusing on expressing ourselves. How the investor is comfortable with my idea. Will the investor understands my terminology or my way of presenting the data or not? That is what I have to understand. That is what I have to focus. Whether the investor will be able to understand this point, what I want to say. Whether the investor will catch my point or not. That's what I have to focus. Whether the investor will be impressed with that point or not, you should ignore. MBA people purely focus on this aspect. Excessive presentation skills. They will try to impress these people. They will try to impress this people. But what I mean to say is that you have to use some technical skills or communication skills from them and focus on expressing. Is my point clear? Is my point clear? Is my point clear? As simple as that. Don't focus on will the investor will be attracted to this point. Will the investor attracted to this point? Don't focus on that. Okay. If you focus on impressing the investor, you will get some investors. But those investors are not have any patience to get. They will put a lot of pressure. Those who attracted for the outside appearance, definitely they are not a good investors. They don't have patience to wait. They don't have patience to wait. They want immediate results. They will put a lot of mental pressure on you to run the business. Therefore, don't run after those kind of investors. You will lose peace of mind in your life. Okay. So therefore, go for the good investors who has the lot of patience to wait to get the results. Okay. Right. That is what the point. So therefore, don't make excessive. Why? Because this is about presentation skills only. But here is where the people are making mistakes. They are making excessive use of presentation skills and they are focusing too much on attracting the customer, rather attracting the investor, rather than convincing the investor. Too much go about the attracting the investor rather than convincing the investor. Emma, have you watched a movie called this? What is called VIP 2 Raghuvaran? Anybody watched the movie called as VIP 2 Raghuvaran movies?
Yes, sir.
Yes, sir.
Yes, sir.
So in that movie, that Raghuvaran and that lady who is that Vasundhara Constructions, okay. So both will approach one person who is one Reddy who is trying to build a hospital. Okay. So both have presented the plans. Ultimately, Raghuvaran's plan is accepted. Emma, you got the? Did you remember the call? Hello. Did you remember that scene? So that.
Yes, sir.
Investor is attracted to the Raghuvaran presentation, not that Vasundhara presentation. Because Raghuvaran presentation is very simple and straight to the point. And that Vasundhara heroine, and she was trying to impress him. She was showcasing. Okay, so the investor is not impressed by her way of presentation. Okay, that is what the point. So he said, you said the same, both said the same concept, both said the same context, but I have simplified and you are arrogant. I have shown my simplicity and humbleness, and you have shown your arrogance. That is the reason you are missing your project. That is where you don't focus on excessive presentation. You will lose very good investors. So if your presentation is impressing and somebody has impressed, that somebody is not good. Okay, don't go with that kind of persons. Okay, right. So it is very important. It is very important to moderate our presentation. It is very important to moderate our presentation. Don't take it to extreme levels. Don't make the presentation to extreme levels. Make use of moderate amount of PPTs and moderate amount of worksheets. Don't use too much colors, too much graphics, etc. Make the point very simple. Make the point very simple. Okay, right. Next, pitch presentation. So it is a brief PowerPoint presentation made to the investors. A brief PowerPoint, brief PowerPoint presentation made to the investors. Brief PowerPoint presentation made to the investors to provide a quick overview of the business plan, and aims to convince. Aims to what? Convince the investor, not to attract the investor. Convincing the investor means making our point clear, making our point very clear, expressing ourselves clearly. That is what. Okay, right. So brief PowerPoint. Don't use too many PowerPoints. Don't use too many PowerPoints and too much content in the PowerPoint. Okay, brief PowerPoint, brief and able to convince the investor. Try to convince the investor. Okay, quick overview of the project. Quick overview of the project. Emma, I'll show you the project I have prepared. I have not made a single PowerPoint presentation, etc. Just I'll show you. Which every investor whomsoever has approached, every investor has accepted